Hello folks, this is Raj Sastry from Raj Option Trading. Today we will talk about one of my favorite strategies. It's a long call butterfly, and this is very popular among traders because it's one of those potentially high yielding trade at a low cost. You don't tie up too much money, and your max profit really, the chance of making money is a little more here. And why do we buy butterfly? This is to generate income, and your outlook here is neutral. You want the stock to be range bound. That's why negative gamma, meaning you don't want stock to move too much. And the time decay here is your friend because you're buying it maybe 30 days out. So it's plus theta, meaning time is your friend here. And reduced implied volatility. You want the implied volatility to reduce or stay low. So that way, the stock does not move on your face. And max profit potential is really capped. You don't make huge amount of money, but at the same time there is a good amount of money you make on a monthly basis. And the max loss is the premium that you paid. So you want you don't want too much loss here. That's why it's a good strategy, if you don't know how stock will move, but it's going to be range bound. When do we buy butterfly? So you want to make sure the stock is range bound, and you want to identify a clear area of support and resistance. And you want to make sure there is no major news headline, for example, earnings or FDA approvals, such things. One of the reason I like to do this strategy with the ETF is with the ETF, exchange traded fund. There is no earnings, so you can really play this strategy very well with some of the ETF and some of the boring stocks. The duration, or time to expiration is 1 month or less. You don't want to go too high here because that will give you more room for stock or ETF to run. And strike price, there are three strikes here. You got a lower strike where you buy a call, and you got a middle strike where you sell two calls, and you got a higher strike which is same distance above the middle strike as the lower. It's the equidistant butterfly. I will also look at example as we go forward. So with that, we will, in a while, we'll hop on to Thinkorswim platform to execute this for S&P 500. And with that, let's look at an example here on a theoretical example. So here we have a stock which is ABC. Stock is at $60, and we could buy two $60 call expiring 30 days out, and then we could sell $2.60 call, and we can buy one $50 call and one $70 call. As you see here, it's the equidistance. There's a $10 distance between 60 and the lower strike, which is 50, and also 60 and the higher price, which is 70. So this is how you construct a long call butterfly. And your max profit is if the stock stays at the middle strike where you sell two calls. If it stays at this price at the during expiration, that's when you make maximum amount of profit. In this case, for a $10 wide spread, you make $700. And you don't want stock to go beyond or below 53 or above 67. So this is where this is your break-even points on both sides. So as you can see here, you got a good amount of range here where you can still make money even the stock moves a little bit against you. With that, let's go into Thinkorswim platform. Let's try to execute a long call butterfly. So I'm here on December 1st, 2020. As you can see here, I will go look at S&P 500 chart. As you see here, S&P 500 is in a good, bullish bound. And if you look at average to range or ATR, it's about $3. So this is 14 days. So here we are talking about 1 month expiration for this strategy. So I would be safe and say maybe it'll ATR could go maybe up to $10 in next 30 days. So with that hypothesis, let's go here, and stock is at 365. I would, think 375 could be a good resistance level. Maybe in a 30 days time, it may not go above it, or it may not go too much above it. So with that, let's go ahead and execute this butterfly. So so we have 375, which is our resistance level. We are selling two call options, and then we are going in and buying a 365, which is $10 below the strike price, and then we're also buying a 385, which is $10 above the middle strike. So as you can see here, now we constructed a butterfly, and because we are selling at two call options at 375, this is where we are collecting maximum amount of money. As you can see here, here the price mark is 270, 265, and if you go down here, it's about 730, and if you go further down here, it's about lower price. So we are getting the money in by selling two call option here, and we are paying money out by buying these two as a protection. So with that, let's go ahead and execute this. Done. And what we can do now is we can go all the way to our expiration date. This is the Thinkorswim on demand. The good thing is you can proceed and go to the expiration date. Let's do that quickly, and let's go to monitor tab. And as it is buffering, yeah, done. So let's go to our butterfly here. This is our butterfly right here. I got a couple more just in case Thinkorswim does not cooperate. As you can see here, we bought the butterfly, um, 31st December expiration. We got two calls here, and we paid 299. And as you can see, for this butterfly, we now made $452. So this is the benefit of this butterfly. So you can, if the stocks, if you understand a good resistance level, then you can sell the middle strike at, there, which typically is above the stock price, and benefit from this. As you can see here, S&P 500 is at 371. We thought the ceiling of resistance is 375. We're a little off, but still it's okay. We kind of that's the benefit of this one. Even if you're not perfectly right, you can still make money. So with that, happy trading. Hope you understood the butterfly long call butterfly option. Happy trading. Thank you.